Reading of Mind Over Markets. We're going to pick up where we left off yesterday. Destination trades. Destination trades. Destination trades are far easier to grasp when you appreciate what time frame is dominating, as well as the visual nature of the market's prominent reference points. Once a directional auction gets underway, the auction tends to travel to a very visual reference. For a day time frame trade, for example, the reference may be the previous day's high or low and a 3-day high or low, or a top or bottom of a gap. The destination for a long-term trade may be from a 5-month bracket high or low to the opposite extreme of that bracket. It may take days, weeks, or months to reach the destination. Of course, destinations don't have to be reached, but they always serve as benchmarks to chart market progress. We often say, put the trade on and monitor for continuation. Understanding possible destinations will help you maintain a better perspective of the multiple auctions and help you better gauge your position performance. For example, it is not uncommon to have a long-term auction to the upside with an intermediate-term corrective auction to the downside, as well as with an intermediate-term corrective auction to the downside, as well as a day time frame trend day to the upside. Employing destination areas from the bar charts will help you sort out this potentially conflicting data and keep this information out of the abstract. The opening. The market profile is a time-sensitive, evolving database that records the market's continuous two-way auction process, the study of which is termed auction market theory. The opening is the first recorded data point each day. We want to observe if the market opens within balance within the previous day's range or out of balance outside of the previous day's range. Of course, in or out of balance is a matter of degree. If we open just 4 ticks below yesterday's high, for example, we would still be in balance. However, the odds are higher that the market will trade out of balance to the upside, or failing that, begin to trade towards the previous day's low. The more out of balance we are to begin the day, the greater the opportunities. The more out of balance we are, the greater odds that the other time frame is responsible. Remaining within balance limits traders to much smaller opportunities when in balance. The odds are also much greater that trading is being dominated in the day time frame. Trends. And some feedback. We have simplified the time frames down to 2. For this discussion, we will determine the direction of the long and short-term trend. The definition of a trend is entirely dependent on your own time frame. At a minimum, we generally want to trade in the direction of the short-term trend, and if you are trading against the trend, you want good trade location. And you want your trade to work quickly. Trade location is the best risk control we have available. Let's review an example, figure 7.10. Remember, these concepts are applicable to all time frames, from 30-minute bars to daily, weekly, monthly bars, and so on. The current trading range evolved from a nonlinear break in early September 2012. You will often find that these types of breaks or rallies define the extremes of the brackets that develop thereafter. This initial range is validated with the excess low 2 and the excess high 3. If you look on the left of the excess low 2, you will see 4 weekly lows. The excess low occurred when price explored below the prior 4 weekly lows and found aggressive, opportunistic buyers responding to the lower prices. We refer to this attempt as a break below the trading range's lower extreme and a rejection that followed a downside breakout. Failure. This is often a strong signal that change has occurred and provides attractive trade location. Remember, trading is about change, and without change, there are no meaningful opportunities. Excess marks the moment of change. The short-term auction to the upside ended with the excess high. Excess and balance are the two most powerful concepts we employ. The rally began with a look below the 4-week balance that led to excess low 2 and signaled the start of a new upward auction. The weekly one time framing higher until excess 3 formed. One time framing occurs when, in this case of a rising market, the next weekly low does not take out or trade below the low of the prior week. Of course, it is a mirror image for a declining market when the next weekly high does not take out the prior week's high. One time framing occurs in all time frames. You want to respect the direction of the one time framing auction, and in most instances trade with it. Following excess high 3, the short-term trend 4 rotated back down. This excess marked the end of one auction and the beginning of a new auction to the downside. The destination trade was to the bottom of the trading range. The prior excess low is seen as the potential destination. The identification of potential destination was based upon experience and observation. As we approach the destination, the risk of the shorts has been increased and the odds of remaining profitable in the short position have deteriorated. Momentum traders often get caught at these levels, as momentum is often the highest at excess lows and highs. Remember, excess is mostly the result of momentum traders taking the auction to extremes. Excess is identified after the fact, after the innovator has stepped in to opportunistically fade the laggard momentum traders. Number 6. The weekly settle following the completion to the destination. Reflect on the risk/reward at different levels along the continuum from high to low. The same analysis is relevant to all time frames. For day traders, we suggest using the daily market profile and placing a green pin on the profile for each day and a red pin placing a green pin on the profile for each buy and a red pin for each sell. After the day is over, review your overall trade location. If the majority of the pins are within the fattest portion of the profile, then you are trading with the majority. You are not getting an edge and you are unlikely to be profitable. If too many of your green pins are near the higher end of the profile and the red pins near the lower portion, then your trading is of the laggard category, and you are likely to get whipsawed. Daily perspective. Every day we seek a balanced perspective by seeking to determine the nature of any existing trends, which time frame is dominating, whether the opening is in or out of balance, and so on, as well as the opportunity that each of these situations reveals, trade location, potential visual destinations, and evolving structural cues. Cognitive dissonance. All humans feel an acute discomfort when we find ourselves holding two opposing thoughts. This is an extremely common emotion shared by traders, but cognitive dissonance can actually be positive for those traders who are willing to think through the source of the dissonance. For example, it is powerful to recognize when a market is rising, but the higher it goes without confirming structure and volume, the better the downside opportunity to follow. The trend may be your friend, but it is equally important to recognize that the trend is ending. Being prepared for change affords us the best trade location and opportunity. Let's see this process in action in Figure 7.11. As we approach the end of the second edition of Mind Over Markets, our examples are getting more complex. Figure 7.11 serves to establish a background for the discussion. Hopefully by this point, you're feeling like you did last time you visited your ophthalmologist. As you sat behind the refractor staring at rows of fuzzy letters, you noticed how they came in and out of focus. Hopefully this is occurring now, as the layers of information that have been presented are beginning to form a recognizable whole. Number 1. Markets continually auction from high to low and low to high. This example begins with an excess high. An excess high marks the completion of one auction and the beginning of a new auction. It is always helpful to ask yourself if the current auction has been completed. Excess is one way that the auction can end, but it is not uncommon for an auction to be temporarily suspended as a result of inventory getting too long or too short. This leads to a short-term counter actions. We often say the market has to take care of current business first. Regardless of whether the long-term trend is up or down, These moves often create short-term inventory imbalances that need to be adjusted. Number 2, following an excess high. Following an excess high, the market gaps lower. The message behind a gap is the total reorientation in thinking has taken place, along with the market's perception of value. Gap is another form of excess. The combination of an excess high followed by a gap deserves respect. The possibility of a suspended intermediate term auction presents itself as a short-term counter auction begins. 1. There is never any certainty until after the fact. However, as you become more skilled at reading and interpreting the market's two-way auction process, you can better assess the odds that it was suspension. A clear excess low is revealed. Remember, excess and balance are the two most important trading concepts we deal with. Following the excess low, the market begins one time framing higher. One time framing is an important piece of auction information. It generally is financially dangerous to trade counter to one time framing. Number 6, an excess high. Number 7, an inside day, a form of balance, develops following an excess high. The general trading rule is to go with any breakout from balance, which marks the start of a new auction. Once again, change has occurred. Take a moment to reflect back on the suspended auction discussed under item 3. The poor low that formed suggests that it would be revisited or repaired at some time in the future, and there is no excess, in other words. No aggressive buying that led to an excess low. Recording and carrying information forward is important for reading the subtleties of the continuous two-way auction process. Many traders complain that this type of information is simply too ambiguous. Yet, the market's best opportunities are often hidden in the subtleties of market-generated information. Having reviewed the overall market and a series of auctions, it is time to transition to the real discussion. The previous example shown in 7.12 included a suspended downward auction followed by a market that was finding ways to work itself higher. We suspect that there are two underlying causes for the auction going higher. The market had gotten extremely short following the excess high seen in our first daily bar chart. 2. The Federal Reserve had reaffirmed its decision to support the bond market by keeping rates low. In figure 7.12, you notice that each day's low was established in the initial pit session 30-minute Y period, which allows us to easily estimate that the determined direction was up. The basic question that we ask each day is, what was the market trying to do, and how effective was the effort? A solid attempt to trade higher would begin with value beginning to develop higher, which we see revealed in the profiles. Additionally, the profile structure would have been much more elongated, with most prices attracting no more than 5 or 6 TPO prints. In the above example, some prices attracted as many as 10 letters. A lot of the time was spent trading at these prices. This is not a science, but rather the art of reading and interpreting market structure. Some markets are open for shorter periods, while others, like bonds and stocks, are open for longer periods. The amount of time spent trading at a particular level relative to the pit session hours affects our analysis of this day. On a solid day, the market is more likely to settle near the higher end of the range. In the above example, the settle for each of the last 2 days is well off of the highs. At the time, I found myself holding two contrasting opinions. 1, the larger auction was down and had been temporarily suspended. And 2, the short covering and short-term momentum buying was occurring, which was related to the Federal Reserve's FOMC release. We always want to trade value, and value was developing higher each day. No matter what my opinion of the long term, you don't want to fade or go against value. This is a good opportunity to reflect back on systems that trade price. In this instance, price was trading higher each day. Yet, while value was also trading higher, the market profiles were revealing structural weaknesses that demonstrated slowing momentum. The odds of upside continuation were weakening, while the odds of market reversal were increasing. The break that began on Friday, September 7th, 2012, took the market down approximately 5,000 per contract over a period of 6 days before a new excess low emerged. The suspended auction that we discussed earlier and revisited and repaired, meaning that the poor, or in this case suspended auction, no longer existed. Imagination. The career of a professional trader is largely dependent upon his or her imagination. If you can't imagine what might occur, it will be difficult for you to recognize market opportunities as they arise. You will end up taking small profits and fading sound off. You will end up taking small profits and fading larger opportunities that lead to net losses, when a chance for larger profit was right in front of you. We foresaw such a scenario in real time when we discussed a similar market situation while recording our live market seminar in 2011. In the above example, a substantial opportunity was identified through positive cognitive dissonance. The dissonance was observing one rising auction and sensing that a reversal was probable. The deteriorating auction, when combined with carrying forward information conveyed by the large suspended auction, allowed us to imagine and capitalize on a large opportunity to the downside. False certainty. Traders are prone to overestimate how much they understand about the markets by looking at price, which often causes them to become overconfident. Nonlinear auctions occur, as we have often stated, when the illusion of certainty is shattered. I'm writing this on a Sunday morning, December 23rd, 2012. During the electronic trade on Thursday evening, December 20th, such an illusion was shattered, which briefly took the S&P indices limit down. Let's examine the market leading up to this break. The final line in our daily S&P market update published just prior to the break read, "I continue to be concerned regarding underlying structure. Thursday's anomalies contribute to my concern." This was an odds-based comment. I certainly didn't foresee a limit down move in just a few hours. However, the odds of holding long inventory appeared to be extraordinarily high. Much of this conclusion was based upon structural analysis, which was similar to the analysis discussed in the last bond example. Two additional contributing observations are discussed below. Anomalies. An anomaly, as described under the glossary in our website, is a single price or price level that lacks symmetry, an unusual structural arrangement in the market profile. An anomaly represents structural weakness. Learning to spot anomalies is the first step towards understanding the pivotal information that anomalies provide. See the market profile from Thursday, December 20th, 2012, in figure 7.13. The profile shows a single price anomaly as well as a price level anomaly in addition. There was a series of poor lows, other indication of structural weakness. Markets in Profile, published in 2007, discusses time frames extensively. When longer time frames are active in the market, they tend to be more aggressive on the highs and lows. Their interest will be more evident through single print buying and selling tails. When tails are non-existent, the higher and lower structural portions of the profile lack excess. In the above S&P example, the lack of buying tails for 3 successive days is an indication that the market is being dominated by the short term. Weaker hand traders. These are the traders that impulsively liquidate and reverse their positions at the first sign of a problem. A single poor low represents one data point, which I give limited attention, but multiple poor lows represent emotional or exponential risk to those holding long positions. The graphic in figure 7.14 shows the risk as the market traded limit down. Market logic. It is not unusual for the market logic to supersede all other analysis and understanding. During the period leading up to Thursday's overnight limit down break, short-term traders who were afraid that they would miss the anticipated rally following a favorable outcome between the president and Congress to keep the country from falling off a fiscal cliff couldn't buy enough. As often happens, they were misguided in their own actions and paid a severe price. Additionally, many reversed their positions only to experience another whipsaw. Other examples of market logic include what didn't happen. Almost all traders can accurately report what actually occurred during a trading session, but professional traders reflect on what didn't happen. What could have happened and didn't is often extremely valuable information. For example, when a negative monthly jobs report fails to lead to a declining market, the market will likely rally. Those left staring at the report are unable to trade with the market and experience a negative cognitive dissonance. As we've often said, the market profile is a valuable analytic tool for recording and interpreting the market, but it should not be employed in a vacuum. We are all day traders. No matter what time frame trader you are, we are all day traders on the day we enter and exit a position. And how we enter our initial trade, no matter our time frame, will ultimately influence our subsequent actions. Understanding that influence, both positive and negative, is vital to success. Positive psychology is an important element for successful trading. Knowing how your emotions influence your behavior is just as important as understanding the fundamental market dynamics discussed in this book. For example, most traders are far too eager to get involved as the market opens, for fear of missing an opportunity. When such a feeling is controlling you, the odds are good that you'll make an impulsive trade as a result. It is common knowledge that impulsive trades seldom work out. There's exceptions. When markets open within balance relative to the previous day's range, the opportunities are usually limited, and it is probably best to wait for better trade location. In this situation, the additional information gathered while waiting will give you a more complete, coherent picture of who is driving market behavior. View the opening on a continuum relative to see the previous day's range. The closer to the center of the range, the lower the odds that you need to trade early. The closer you are to the previous day's extremes, the more likely you can benefit from early entry. The more out of balance the market is relative to the center of the range, the greater the opportunities. Attractive opportunities usually develop around gap openings, and gaps reveal the ultimate out of balance experience. The bigger the gap, the smaller the odds the gap will be filled during the current trading day. This may feel counterintuitive, but the bigger the gap, the more likely the longer time frame traders are caught the wrong way and will likely have to trade in the direction of the gap to adjust their existing inventory. Free from distractions, we continue until we reach our goal. While it may seem strange to quote a Swami in a book on trading, we can think of no better goal than the one commonly described by wise folks throughout the ages. We must free ourselves from attachment to desired outcomes if we are to see the world as it really is. In reading this book, you have made progress on your path to becoming a successful trader. Over time, you will transform these insights into instincts in the kiln of experience. And those instincts will help you rise above the distracting maelstrom of conflicting information with a broader, more holistic market perspective. You'll begin to understand the big picture while also participating in the daily minutiae. That is the hallmark of a professional trader. Developing this level of market understanding is not an easy process. Most people find it impossible and even parse ambiguous, conflicting information, let alone transcend it. But armed with awareness, you have the ability to separate yourself from your competitors, most of whom are lost in the shallows of price and opinion. You have the opportunity to forge your own path toward expert. Good luck on your journey. Appendix 1. Value area calculation. I don't know if we're going to read this stuff. This stuff is more just like analytical data. It's not actual information. So let's do this. Actually, we'll stop the stream here and we'll